Welcome to the deep dive. So today, we are looking past all that celebratory confetti, the bright lights of Las Vegas. We're talking about the World Series of Poker main event. And there's that one number everyone knows.
Yeah.
$10 million for the winner.
Uh-huh.
It's the peak of the mountain for poker. The closest thing you get to real immortality in the game.
It is the dream, absolutely. But, while that $10 million headline makes for great TV, the pros, they know the real win doesn't happen on camera. It happens at an accountant's office months later. The conversation we're about to have is the one that happens after the cheering stops. Because that giant check they pose with, it's functionally an illusion.
Right. We just assume that number is the finish line, 10 million, you're set for life. But our sources, they lay it out so clearly that number isn't the end. It's the starting point for one of the most complicated financial wins in all of sports.
Exactly. The headline prize is fiction, the net amount you actually keep. That's the reality. So our mission today is to peel back all those layers, the legal stuff, the financial traps, the practical realities, to get to the bottom of it. How much money does that champion really walk away with?
Okay, let's just dive right in with the initial shocker. How the IRS, the Internal Revenue Service, sees that $10 million. Because when you think of sudden wealth, you think lottery, maybe investments, things with, their own tax rules. This is completely different. Why is a poker win considered unprotected income?
Well, because the IRS doesn't really romanticize it. They don't see it as a game of chance or a clever investment. To them, the World Series of Poker is a competition. It's labor. And that prize money, it's treated as ordinary income. It gets taxed exactly the same way as the salary you get from your 9-to-5 job.
And when you're suddenly handed $10 million in ordinary income, I imagine that has some pretty immediate tax bracket implications.
Oh, yeah. It shoots you straight to the top. The highest federal income tax bracket in the U.S. is, over 37%. So you're immediately talking about a tax bill of roughly $3.7 million, just gone. Right off the top, just for the federal government. But that's not even the only hurdle.
What else?
The IRS demands, and I mean demands, perfect documentation, extreme precision. So if you want to claim any deductions, or if you had any kind of financial deals to get into the tournament, which we'll get to, you have to have proof. Every buy-in, every flight, every single agreement needs to be provable. If it's not, they can just decide that entire $10 million is yours and yours alone with no deductions.
So the $3.7 million federal tax is the first punch. But our sources say the unexpected uppercut is the state tax. And this is where geography becomes a multi-million-dollar decision.
This is a huge factor, and it's one that fans just completely overlook. Most people assume, okay, it's in Las Vegas, Nevada. Nevada has no state income tax, so you're safe, right? Wrong. It doesn't protect the winner at all. Your tax bill is determined by where you legally live, your residency.
Wow. So you could have two players at the final table, side by side, same number of chips, playing for the same prize, but in reality, they are playing for wildly different amounts of money.
Absolutely. And that's why you see so many professional players structuring their lives around this. It's not just a lifestyle choice to live in Nevada or Texas or Florida. Those are all 0% income tax states. And moving to one, it is literally a multi-million-dollar financial strategy.
Okay, so let's put some hard numbers on that. What happens if the winner is from, say, California or New York?
If you're from a high-tax state, the hit is just staggering. A California resident who wins that $10 million, they could owe the state of California up to 13.3%.
Wait a minute. 13.3% on $10 million. That's over $1.3 million just to the state.
Correct. So now you've got the $3.7 million federal bill. Yeah. Then you stack that $1.3 million state bill right on top of it. You're at $5 million in taxes. And that's before we even touch the most complex and honestly the most dangerous part of tournament poker financing, the backing system.
Okay, this is where it gets really, really counterintuitive. We have to talk about backing. For anyone listening who might not be deep in the poker world, what is that? Why is it the backbone of these big tournaments?
So backing or staking is basically selling shares of yourself. You sell a percentage of your entry fee and any future winnings to investors. The variance in poker is just so brutal. Even the best players in the world can go ages without a big score. So selling action, as they call it, reduces your personal risk. That $10,000 main event buy-in becomes manageable if you only put up, say, $3,000 of your own money by selling 70%.
Okay, that makes perfect sense from a risk management point of view. But you said it carries a huge financial danger. What's the tax twist here? If I sell half my action and I win $10 million, shouldn't the IRS only tax my half? The $5 million.
That's what everyone assumes, and it is an incredibly dangerous assumption to make. Legally, that $10 million price check, it has one name on it, the players. So in the eyes of the government, that full amount is your gross income.
But but if I turn around and wire $5 million to my backer, why does the IRS care? That's a private deal, right?
They care because unless you have ironclad legal documentation, and we're talking a formal partnership, an LLC, a clear contract drawn up by a lawyer, the IRS just sees that $10 million as your income, the $5 million you pay your backer. They see that as a personal expense, which is not deductible, so you get taxed first. Then you pay your backer second.
Oh, that is the critical point. So I win 10 million, I've sold 50%, I owe my backer 5 million, but without the right paperwork, I could owe 5 million in taxes on the full 10 million. I'd be left with nothing. I could even be in debt.
That is precisely the nightmare scenario. If it's mismanaged, a player is on the hook for 4 or 5 million in taxes, while their actual share was only 5 million to begin with. We've seen it happen. Poorly structured backing deals have led to just catastrophic tax bills, lawsuits, even federal investigations, all because the winner couldn't prove that the millions they paid out wasn't actually their personal income.
We should probably touch on the global side of this too, because the WSOP, it's like the Olympics of poker. It brings in players from all over the world, and if you're not a U.S. resident, the whole financial picture changes again, doesn't it?
It's a completely different rule book. It's all based on these really complex international tax treaties. For a non-U.S. winner, the casino will often just withhold up to 30% of the prize money, instantly.
30%. That sounds really harsh.
It can be, but this is where those treaties are so powerful. If the winner is from a country that has a great tax treaty with the U.S., like, say, the United Kingdom,
Wow.
they often end up paying 0 U.S. tax. They just have to file to get that initial 30% withholding back.
So you're telling me a player from the UK could walk away with way more money than a player from California, even if they won the exact same prize?
Oh, absolutely. The difference is just astonishing. But then you have the other side of it. Take a Canadian winner. They can face U.S. withholding, and then they get taxed again back home in Canada. It's a double whammy. We've seen past international champs, because of this perfect storm of taxes and backing deals, end up with less than 25% of the headline prize.
That is a wild global puzzle. Okay, let's get to the last big factor. The difference between being a pro and being an amateur. It sounds like a small distinction, but it can save the winner a fortune.
It is a critical dividing line. A true professional poker player is seen by the IRS as running a business. They file their taxes on what's called a Schedule C. That's the form for business income and expenses. And this lets them deduct a massive amount of their costs.
Like what, for example?
I mean, everything. Everything it took to generate that income. All their tournament buy-ins for the entire year, their travel, their hotels, even coaching fees, study software, a home office. All those deductions reduce their taxable income, and that can save them hundreds of thousands of dollars.
And the amateur, the accidental professional who just caught lightning in a bottle.
They file it as other income, and they can't take any of those deductions. So imagine someone wins the 10 million, but they spent $500,000 that year on buy-ins and travel to get there. The pro deducts that $500K. The amateur can't. They pay tax on the full 10 million. It's a financial tragedy when that kind of success arrives without any structure.
So let's put it all together. What does the math actually look like? I want to use the scenarios from our sources to give the listener some really concrete numbers to hold on to. Let's connect all these pieces.
Okay, let's start with the most dramatic scenario. And sadly, it's also a very realistic one. This is our California resident. They sold 40% of their action to backers, and they win the $10 million prize.
10 million headline.
Right, and they're on the hook for the full tax bill. So we said that's $5 million total, 3.7 federal, 1.3 California state tax. Now, they also have to pay their backers. 40% of $10 million is $4 million.
Okay, wait, let me just run that. They own 60% of themselves, so their share is $6 million.
Their gross share is $6 million, yes.
Yeah.
But their total tax bill, the money that has to go to the government, is $5 million.
So their net take-home, the money that actually finally hits their bank account after every debt is paid, is $1 million.
That's the shocker. From a $10 million headline to a $1 million reality. It's all because of high state taxes and that trap of being taxed on money that you have to pay out to your backers. That player basically paid 83% of their own winnings to the government.
That is just, it's astounding. You win the biggest poker tournament in the world and keep 10%. Okay, let's flip it. What's the absolute best case scenario?
That would be our Nevada resident, 0 state income tax, and they played the whole tournament on their own dime, no backing.
So prize, 10 million.
Tax is federal only, that's 3.7 million. State tax is 0. Their net take home is $6.3 million.
The gap is. It's breathtaking. That one difference in residency and backing means one player keeps over 6 times more money. A $5.3 million difference, just based on where they lived and how they financed their entry.
And that gap,
Hmm.
it really shows you the true pressure of that final table. Historically, we've actually seen situations where the champion, because of a bad residency or messy backing deals, ends up with less net money than the person who finished in third or fourth place. That financial maze can turn this incredible dream into a huge, huge struggle if you're not ready for it.
So we're looking at this massive range, a take-home of anywhere from 6.3 million all the way down to below 1 million. All of that is hidden behind one big number. The real challenge isn't beating thousands of players, it's navigating the financial jungle afterward.
Absolutely. Winning the bracelet is only half the job. As soon as those cameras are off, that winner needs a world-class tax attorney. They have to calculate the splits, set aside the right amount for taxes, and make sure all that paperwork is perfect. If they don't, they're looking at years of painful IRS audits. The entire future, that long-term security, it all hinges on protecting that initial win.
The ultimate contrast here is just so fascinating. In poker, you live with variance. Sometimes you get lucky, sometimes you don't.
That's right. Poker has variance. But taxes do not. They are a certainty. The champion who understands the numbers, who manages the aftermath with the same skill they used at the final table, that's the person who turns a one-time score into real lasting wealth. They become a true financial professional. That knowledge, that's the real skill.